Would you like to be able to use your superannuation to buy a property? That's what most of our clients do by setting up a self-managed super fund. A self-managed super fund, or an SMSF, allows you to take control of your super by investing it in an asset of your choice, like property. Let's take John and Mary for example. John and Mary contact our financial advisors at Wealth Inspired to find out if they can use their superannuation to buy a property. They don't have enough super to buy a property outright, but they do have enough existing super for a deposit to secure a loan. They decide to go ahead with a self-managed super fund so that they can invest their super in a way that works for them. Here's how the SMSF structure works. The first thing John and Mary need to do is set up a trust deed. The trust deed is a legal document that outlines all the details of how their super fund is going to operate. John and Mary decide to name their trust the Smith Family Super Fund. Next, they need to decide how the trust will be supported. John and Mary can either be individual trustees of the fund or set up a company structure called a corporate trustee to act as a trustee of the fund. John and Mary decide to set up a corporate trustee, which allows them to limit their risk of personal liability, make it easier to change members in the fund, and be able to approach a lender. They call it Smith Super Pty Limited, and they are now the directors of their company. Next, John and Mary open up a bank account to transfer their existing super funds into and manage their SMSF transactions. They weigh up if it's worth keeping some funds in their previous super accounts to retain insurance benefits, as they may not be able to access new cover given some health issues they have had over the last 5 years. The best case scenario for them will be if they can access better policies at more affordable premiums. John and Mary decide to move $100,000 each into their new SMSF account, giving them a total of $200,000 and 50% ownership of their fund each. As they have their own account balances within their SMSF, which means they will each receive 50% of the earnings and pay 50% of the costs of the account. Their employers can now pay their superannuation into their SMSF bank account. Now that their SMSF is set up, John and Mary, together with their financial advisor, create an investment strategy. Because they want to invest in property, the next step is to engage a mortgage broker and property consultant. The broker will help them secure the funds they need to buy property, while the property consultant finds them a suitable property for their strategy. The broker will help them secure the funds they need to buy their property, while the property consultant finds them a suitable property for their strategy. Finding the right property is a crucial step for their strategy to work, so getting the professional advice is a must. John and Mary want to purchase a property worth $500,000. They can borrow 70% of the purchase price, which means they need $150,000 deposit plus about $25,000 to cover purchase costs. To set up and run their SMSF for the first year will bring the total liquid cash required up to approximately $220,000. So how can they purchase a property if they only have $200,000? It's easy. Once you add up their employer super contributions and the rental income they make from the property, John and Mary will have an extra $42,500 in their SMSF account after the first year. This means that they will actually have $242,500 to set up and run their SMSF and will have $22,500 surplus after year 1. There's one last step before John and Mary make their purchase. They need to set up a bare trustee company. This company becomes the legal owner of the property and takes on the mortgage on behalf of John and Mary until they pay out the loan. Having a bare trustee company creates what we call limited recourse borrowing. This means that if John and Mary don't make their repayments, the lender can reclaim the property but can't come after John and Mary, other assets, or them personally. John and Mary go ahead and purchase their property. The money made from rental income goes into the SMSF bank account where the mortgage repayments come out. Now, while John and Mary are still working, they are taxed at 15% on their rental income and 50% on superannuation contributions, which is less than the ordinary tax rate. But when they retire under current tax law, they will not be taxed at all. Also, if John and Mary decide to sell their investment property before they retire, the gain will be eligible for a discount of 1/3 and the net gain tax as income. For example, at 15% tax opposed to 50% gain needed to be declared to pay tax at the individual's marginal tax rate, which could be as high as 47% if there were an ordinary investment property. If that wasn't good enough, capital gains tax drops to 0% once John and Mary retire. So who supports John and Mary in managing their SMSF? At this stage, John and Mary have a team of professionals on board. They include a wealth-inspired financial advisor operating as the managing director of the company. We make sure that the strategy is implemented correctly from its development to property settlement and that the property is tenanted. We will also oversee the other professionals on board, including the mortgage broker, the property consultant, conveyancer, property manager, and SMSF administrator. We then work with the SMSF administrator and property managers to make sure that the fund and the property are reviewed regularly unless John and Mary decide to take on this role themselves. To find out more about setting up a self-managed super fund, call Wealth Inspired on 0407 742 042.